Welcome to Level Up Real Estate Investing Podcast with Robert Hyder. This is a no-fluff podcast where we dig deep into the journey of scaling your real estate investing and wholesaling business and discuss how to break into commercial real estate investing. Hey everyone, welcome to Level Up Real Estate Investing Podcast. Really excited here. We've got Joel Dauve with Millhouse and Neal, a partner there. He's been at Millhouse and Neal for 17 years. We've worked with Joel and his team for, I want to say at least 4, but it feels like even more than that. Very smart guy. I think he's got some really good insights. Specifically, what we're going to talk about is the CARES Act and some of the new things that are coming into it. Not everyone, but a majority of folks know about the PPP program and all the news around that and the emergency disaster relief loans and a bunch of the other little pieces kind of associated with that. Those have been in the news a lot. But the thing that I think people have been missing out on is the qualified improvement program, which is kind of like a cost segregation study. And we're going to get into the details. So if you don't know all that stuff, we'll dig into it. But it can be a really good benefit for folks if their kind of current asset situation lines up, if they have real estate assets and they put certain improvements into them. And then there's some other pretty interesting kind of benefits that came out of the CARES Act as it relates to that. So without further ado, Joel, I miss anything or all that? I touch everything there?
No, Rob, I think you nailed it. I just wanted to say thanks so much for having me. I really appreciate the opportunity to sit down and chat with you about this stuff because it is certainly an interesting time that we're living through these days. And as you noted, the loans and the PPP program are probably the most exciting thing to come out of this pandemic from the Treasury and from the IRS, but there are a couple of other items, and specifically this opportunity to carry back net operating losses for 5 years that when coupled with some of the other depreciation opportunities that are available to specifically, well, I should say for the most part, commercial real estate investors, we're seeing some pretty exciting opportunities and are able to generate some really significant tax savings and even refunds for people that weren't able to tap that money before.
Yeah, and obviously we've been talking through this in pretty good detail. So I've got some backstory. I'll be asking questions that I think listeners might be thinking as it kind of goes through this, and maybe some of the stuff that was kind of going through my mind as we were originally talking about it. But out of the cuff, I think I know the answer to this one, but is it possible to use the qualified improvement program on residential properties, or is commercial, you get cost, cost expensed out a little bit on the process?
Yeah. So the qualified improvement property is specifically commercial property. It does not include residential. This was a concept that had been around for a number of years, even probably prior to you and I working together within the restaurant industry specifically, and they allowed restaurants to deduct as bonus type depreciation, qualified improvement property, which is effectively building improvements or leasehold improvements, sort of generalized for restaurants. In 2017, as part of the TCJA and the big tax cuts that we're operating under still now,
those are the big Trump tax cuts, right?
That's right. Okay. They expanded that to include all commercial real estate, and interestingly, they actually dropped restaurants off of it. Part of why that has come back into the news or has gotten some refreshed attention is because within the CARES Act, they corrected what they deemed to be an error or an oversight when they rolled out all those new tax cuts, because they actually took it away from the restaurants. And now they said, oh, wait, we didn't really mean to do that. if you recall, that whole thing was pushed through in just a couple months, whereas a lot of times tax changes are happen at a glacial pace, and this was really lightning quick as far as those things go. So it's not a terrible surprise to find that there were some T's not crossed and some I's not dotted out there, and this is one of those things. So effectively, what it does is on a global basis is improvements that you make to commercial real estate that you own can be subject to bonus depreciation and or Section 179. Bonus allows for the full depreciation without regard to income within that activity, whereas Section 179 expense is tied to the income of the activity and then the income of the owner and has those hurdles. You can't take a loss or produce a loss with Section 179, whereas you can with bonus depreciation. It's kind of the biggest distinction between those two for the purposes of our conversation here today.
Got it. So yeah, so as it relates to qualified improvements, so you kind of touched on it there. So they differ from a traditional cost segregation, which let me try and make this as simple as possible. So with cost segregation, you essentially go and you take a current asset, a current real estate property, and you segregate out what is defined as the real property, the actual real estate, versus what's more kind of quote unquote personal property. So, HVAC systems and gutters and roof and different things. And the thought is those different pieces of the property would depreciate at a faster pace than the overall real estate as a whole. So instead of the 39-year term for commercial, it would be a much faster pace. A roof might depreciate 10 years or whatever the study allows. Now, the difference between the standard cost seg study, which has caught a lot of attention recently, specifically with all of the kind of apartment syndications and things going on out there. That's a big advantage for folks that are going into these syndications to have this cost seg aspect so that you can accelerate the depreciation and essentially create a gain, but without having to pay taxes on it. But the difference between the cost seg and the qualified improvement property is that when you buy the asset and it has all of these improvements into it already, then you can use cost seg, but you could not use qualified improvement property because you actually physically have to do the improvements in order to use it. Is that fair?
Yeah, that's exactly right. And a further distinction is cost segregation can be used on residential property, whereas the qualified improvement is specifically for commercial type buildings. So, you're on the right track there. And for the most part, in a cost segregation study, the assets are componentized into personal property, just as you said, which ordinarily is depreciated over 5 years, but can be accelerated under bonus or 179 into current deduction, or a land improvement, which is a 15-year asset, and that's actually effectively what the qualified improvement property designation does as well. Is it makes it 15-year property, which then, because it's 15-year property, it is eligible for bonus and Section 179 accelerated depreciation.
Perfect. And guys, bear with us if you're listening and you're just taking waves over the side of the boat and it's just too much. Just bear with us for a minute. We're going to go through an example. I think it'll make a lot more sense and kind of draw it all together. But we're kind of setting the groundwork of the differentiation between the two pieces, and then also kind of apply in some of the things that I'm really excited for Joel to talk about is kind of the net operating loss carryback. That's where there'll be big opportunities to get some advancement, I think, from one of the really good things that came out of the CARES Act. But cool. I didn't mean to cut you off, but yeah, keep going with all that, and then we can dig into the carryback.
Yeah, so I thought maybe a good way to kind of bring some of this stuff home, if I can leap off the groundwork that we've laid with a case study, is I'm going to give you basically a real life example of something that we were just able to do with a client here, over the past 6 weeks or so. So The situation was that he had some high income years, actually sold a business or two back in the early teens, and was just generally like 2013, 2014 type range, and generally had high income years. You may recall back in those days, taxes were a lot higher. The top income tax rate for individuals was 39.6% as opposed to the 35% we've got now. So this client was paying into the top rates for a number of years there. And here recently, he he sold an old business and decided he wanted to shift into commercial real estate. And so he bought some dilapidated buildings in 2018. He dramatically repaired them, spent 1.2, 1.5 range in fixing them up, and didn't really have any other income to speak of going at that time. So because it was after these Trump tax cuts in 2017, although all of the improvements that he was making were qualified improvement property, there really wasn't a great value to taking that accelerated depreciation because there was no opportunity to carry back those losses. At the same time, they reduced the rates and they made a lot of other, qualified improvement property things available to us. They took away the net operating loss opportunity, which used to allow you to carry things back for 2 years. So anyway, what we were doing was simply, we'd elected with Section 179 on these qualified improvements that he'd made, and so we were just running the rental operation and the business that he operated within at a break even. We'd take Section 179 to wipe out the income every year on his, or for 2018 and 2019 on his personal income tax return. And then he had still yet $1 million worth of depreciation that he was just going to have to carry forward off into the future until there was income to offset it against. So when, as part of the CARES Act, they allowed for this new 5-year carryback for basically anything from 2018 to 2020, we were able to go back and of course, because he made the repairs, we were able to identify those improvements, and rather than elect that Section 179, which limited the loss or the depreciation he could take to his income on the activity, which of course was just getting started and was virtually nil. Now we're able to write off that full $1.2 million in an amended 2018 tax return. The value to that is that then we were able to carry it back against 2013 and his 39.6% income tax rate to generate a refund of something in the neighborhood of $475,000. Now, bear in mind, this depreciation is always a timing difference. It's always something that if you take it now, you're not going to have it later. If you can't take it now, you will have it later. So in his case, that shifted things such that, his income for 2019 went up dramatically because we wiped out, we utilized all that depreciation. But right now, while he needs it, while the economy is struggling and the rest of his tenants are struggling to pay their rent, and he's struggling to operate the businesses within his real estate, he's going to get this $475,000 windfall that not only helps him through this tough time, but is offsetting a 39.6 tax rate rather than a much lower rate here at present.
Perfect. So the big key takeaway is that we now, instead of just having cost seg and section 179, which is just a section of the tax code that allows you to accelerate the depreciation on certain assets, kind of within the real estate. So as opposed to just having the cost segregation tool with section 179, we now have the qualified improvement property plan. So we have that. But then the other variable to that is that we now have the carryback option. When in the past, prior to Trump's rollout of the new tax reduction, you could go back and carry back 2 years, which was beneficial. But the real benefit now is that you can carry back 5 years. So, and 5 years as of 2018. So, which means you can go all the way back to 2013. So, and that compounds in benefit based on the fact that tax rates were higher back then. So if you had good years in 13, 14, 15, 16, before the kind of, they started kind of falling on a rate basis, or even if that wasn't the case, even if you had a good year when the rates were a little bit, we're at 35, but you could just get an accelerated benefit of that, of this new tool. It's just a new lever. And the real kind of cool thing about it is, and what we've been digging in pretty deep on, Joel, with you, is that, okay, this instance, this guy has some tenants that aren't paying, and it's nice to have that money. You know, my guess is he probably doesn't have $475,000 worth of tenants that aren't paying, you know, for a couple of months or whatever. But what he does now have is the ability to kind of use this tool to then go back at a higher tax rate year, take those funds, get a reimbursement or get a refund from the IRS for almost $500,000. And then now he has the ability to go and maybe offset some losses, but really also go out and buy another asset or new assets with, I mean, quote unquote, kind of found money to some degree. You know, he wasn't planning on being able to go back 5 years and pull from some of these high income years. And then now he has the ability to go out and he has this $500,000 in funds ready to go and probably take advantage of an opportunity because, you know, I think in the next 3, 5, 6 months, we're going to start seeing some pretty good opportunities kind of start to sneak out of all of this on the commercial side specifically. We'll see on the residential side. It seems to be holding up pretty well with a lack of inventory. But in this guy's instance, this is a really, really good opportunity. And there's probably a lot of folks that are listening to this right now that had pretty darn good years in 13, 14, 15, you know, folks that were in the residential industry and didn't get stuck with a bunch of inventory coming out of the 08 recession were doing pretty darn well in those years if you were operating. So, and I specifically remember those tax rates being quite a bit higher. So it's something that we're digging in very, very deeply into with some of our commercial assets that we have kind of been holding off on the cost seg basis just because tax rates have been relatively low and there's been some other pretty good tools that we could kind of dig through to maybe hold off on making that cost seg kind of, or pulling that cost seg lever for lack of better terms. But now being able to go back, take the accelerated depreciation, take that loss, quote unquote loss, and apply it to past years. Now we can get like real cash today that we can go out and invest. And if we can get assets at 15, 20% cheaper than we could in January, given the current kind of environment, well, there's a double benefit to this for some real estate investors if you have the ability to kind of pull on this lever.
Yeah, that's exactly right. I do really like your phrase regarding pulling the levers because that's really exactly what it is that, you know, like I was saying before, this depreciation beast is all just a timing thing. But what all of these levers are doing is allowing you to take a higher degree of ownership and management of those levers and of your overall machine, especially as relates to the depreciation opportunity, and say, when does this best benefit me? Does this best benefit me today when, you know, maybe I'm paying, maybe it does, you know, maybe I need cash right now. Maybe as Rob, you mentioned that you're, you know, looking at a buying opportunity and wouldn't it be great to have some cash to be able to do that? At the same time, you know, in some instances, maybe in my situation, I'm better served holding off. I have X coming in the future, or, you know, my big year was really 2015. So I'd much rather make all of this choice in 2020 to carry it back to that year. You just have lots of opportunities to sort of maximize the depreciation and the deductions, and then there are the opportunities for arbitrage with the higher rates in the past and so forth that make it even more attractive and something to really look at pretty carefully in short order to make sure you're maximizing.
Yeah, absolutely. I know that your mind kind of works this way. Mine works somewhat similar, where I can make sense of all these different kind of options and compound them to some degree, where you're saying, okay, well, you can pull this lever, get this depreciation loss, apply it back. And because it's at a higher tax rate, you're actually gathering more income than if you were to pull that same lever and apply it to this year or future years. So it would make sense to do that. And then you take that a step or two further and you say, okay, well, in addition to that, so I'm getting more for doing the same thing today by doing that. And at the same point, if commercial real estate asset prices are down 10, 15%, 20% in 6 months, great. I've got further cash reserves. I've got further dry powder sitting here ready to make a move. And with that dry powder, I can now get even better financing rates than I could in January. We've got local banks here that are doing, the non-recourse market's pretty slow right now, but we've got local banks that are doing 10-year fixed rate deals at 3.75 to 4%, which is very, very uncommon for our market. So we get 10-year fixed rate, 3.75 to 4% interest on those deals, and then also be able to buy that property at a discount and then use past funds that we didn't otherwise think we'd be able to pull on and apply those to be able to do that. You can really compound that deal to have exponentially more benefit than it otherwise would have had.
That's excellent. There. Very good, Rob. Yeah, I think so. And I think, none of this should really be done in a vacuum. It does not make sense to just run out and do a cost segregation because you got a building, because you can. There are implications. Is now the best time? Is later going to be better? What is my exit strategy? Does any of this make sense to me at all? Because of course, again, it's a timing thing. And while, a dollar today is generally better than a dollar tomorrow. Well, what if that means I'm in a bad spot, in a few years and I've got to sell or something else, because there are implications now. Or what if I'm going to sell in a short term? It doesn't make any sense to go to the time, expense, and effort to do this study if you're only going to turn around and sell it and have to recapture all that depreciation right back in the next year or the next 2 years or something along those lines. So I think it's an important conversation to have with the professional in order to make sure that you really are seeing the whole picture and not just one particular opportunity by itself.
Yeah, absolutely. And that's some of the stuff that you were kind of mentioning to me and just, hey, be aware of what are some risks. Here are some things to kind of talk about. So you're kind of tiptoeing into it there a little bit, kind of talking about the risk associated with maybe even having a non-cash gain, or kind of having these scenarios where you go to sell it in 2 years. You have to pay some additional accounting expenses to do this. You have to pay some engineering studies for the cost seg study to be able to do this and use this depreciation and go back and get those funds. But if you're going to sell the property in 18 months, then you outlaid the expense and you probably didn't get the benefit out of outlaying all those expenses in that short of a period of time. So something worth evaluating. But if you could kind of get into the non-cash gain stuff that we're talking about, and then specifically the fact that I think a lot of people, when they start looking at non-cash gains, which just means you sell a property and you sell a property and technically you would have made money, but because you depreciated the asset so much, you're paying taxes on a much larger amount. But people think they can make up with that with doing a 1031 exchange, and that's a not necessarily true.
Yeah, that's an excellent point. One of the things that we're doing when we do a cost seg study in particular is that we're moving that property from a long-lived asset, depreciable over whether residential 27 and a half or commercial 39 years. You're dropping that time period down to 5 or 15 years, or indeed probably taking it all in 1 year. And that has now shifted the property type, and it's now personal property as opposed to real property. So two things there. One, when you sell personal property, that's going to be subject to ordinary gains. That's going to be at your marginal tax rate without the long-term gain treatment applied to that component. So your tax is going to be higher when you go to sell that property when you've got that personal property component within your building. Now, bear in mind, you did get the deduction at that same rate, but if you took that deduction into a loss or into some of the lowest brackets, and then when you turn around and sell next year or something in a short term, and now you've got a higher overall income, well, suddenly you're paying more tax on that same property than you just saved the year before if your income's higher and then you're into, by virtue of the sale, quite possibly, a different tax rate. Beyond that, another thing, you mentioned 1031 exchanges that I wanted to touch on is another component to the TCJA, to the Trump tax cuts from 2017, was that 1031 exchanges are only allowed for real property. They are not allowed for personal property. At one point in time, we could trade in cars on a tax basis and so forth. Well, none of that exists anymore. It's only real property for real property. So wait a minute, I've just shifted. I did this cost seg study, and now I've shifted what I thought was real property or what I had carried as real property to personal property. You can't 1031 exchange that under these new rules. So even though you're doing a 1031 exchange, you may well have taxable income at an ordinary rate based on the personal property component within that sale. And yeah, that could be a significantly high tax. And if you're leveraged to where you're not cashing out money at the point of the sale, you owe the bank, maybe you refinance the property a time or two along the way to buy new stuff or whatever the case may have been, you may have a pretty significant tax liability. Now, if you do a 1031 exchange, one thing to not lose sight of is that new building probably has just as much or maybe even more personal property as the one you sold did. So there is an out there on the 1031, assuming you go ahead and do the same analysis to find that personal property over again, probably via a cost segregation study. And then your depreciation there, you should get the same, bonus or Section 179 that you can now use to offset the gain that you had before. So, there's a school of thought that it really didn't change things too dramatically in the 1031 world, but it's just something that you need to be aware of as you're thinking through, in particular exit strategy on each individual building.
And we've talked about this in detail. I saw some people get clipped during the 2008 recession when I was in banking. Folks that accelerated some depreciation, did cost segs, and then also when asset values were high, they refinanced the property or they took a line of credit out against it and used it to purchase other assets or anything that would have levered up the property. And then they got clipped in this scenario where they couldn't refinance an asset. They needed to sell it. And even if they sold it at or a little bit above their debt level, which they felt good about because it wasn't at a technical cash flow loss. But if they would have, let's say the asset was worth $5 million and they had $4 million in debt against it, okay? But if they did a 1031 exchange, if they did a cost segregation study on that property, well, that property had been depreciated down, so their basis in that property might have been what's called $1 million, right? So they sell that property for $5 million, like I mentioned. Cool. They paid off the bank. They paid off the $4 million loan. They paid the broker. They're ready to walk with, $800,000, something like that, and they feel good about it. Cool. They got $800,000 in cash in hand. Great. Except they sold it for $5 million, and their basis was $1 million. So they have a $4 million gain on the sale of that property, of which it could have been taxed at, a portion of it would have been at long-term capital gain. So if they're a high earner, and in this case, it would have been 25%. But also the personal property would have then be taxed at 35%. So whatever that split was. So let's say it averages out to be 30% between those two for hypothetical scenario. Well, cool. 30% tax rate on $4 million is what, like 1.2, 1.3, something, right? In that ballpark.
Now you lost $400K.
Now you got to pay 1.2 in taxes, and you only have 800,000 in the deal, in the actual bank from that sale. So what happened? You had a non-cash gain. You have a gain on the sale. You don't have the cash in hand to pay. And that same person who was probably struggling with the bank, wasn't allowed to refi, probably doesn't have another 400,000 sitting around. He's ready to write to the IRS right then. So that's how you get clipped. So long story short is, guys, and everyone listening to this, the likelihood of all of that making perfect sense is probably pretty low. The key takeaway is here, as you start looking at these pretty sophisticated tax strategies, specifically ones that are kind of coming out of these new kind of tax, these new rollouts, these new acts, the CARE Act and all of that, like just make sure that you're working with someone that really understands all the different pieces and know that when it comes time to sell, you can't look at selling that asset the same way that you otherwise would look at selling an asset. You got to look at it a little bit differently. You got to analyze the kind of next level strategy. You got to be thinking 2 or 3 moves down the field a little bit. Like, does that make sense, Joel? Does that kind of sum that up to some degree?
Yeah, I think that's absolutely right. That there's a lot of opportunity, but just be careful. Make sure you're not. Make sure you're watching the big picture, and as you say, as best you can see a few steps ahead of yourself, better off you're going to be. And the best way to probably do that is to find yourself an experienced consultant that has seen all this stuff before. And can therefore tell you what to watch out for.
Absolutely. And what I'll do, and this was not intended to be a pitch for you at all, Joel, but if you'd like, I'll throw your info down in the show notes so people can reach out to you if they're interested.
Yeah, that'd be great. Yeah, sure.
Absolutely. And like I said, he's a great guy and it's done very well for us. So can't say enough good things, but like I mentioned, it's not necessarily the concept here. The concept was that we've been digging super deep into this on some of our commercial assets. And I thought, hey, I didn't realize all these different variables and how we could layer these pieces quite to the level that can be done. And as a matter of fact, literally as we've been talking, I've been thinking of additional ways to layer on the model of kind of looking at low interest rate debt right now. And it just kind of was on the fly a bit as we're kind of thinking through this. But the key is, like I mentioned, just make sure you're careful on that non-cash gain, and that the 1031 can't save you, because I think a lot of folks think that it can. And specifically, recently, anyone that's been involved in syndications, raising money for syndications, helping another sponsor they know that's running one, more times than not, they haven't thought this deep into what these scenarios look like. And I've been seeing a lot of syndications specifically in the apartment market. And who knows what's going to happen. Hopefully they don't get clipped, but there's a fair chance from what it looks like right now that they're going to get beat up a little bit, right? So if a scenario comes where you are the limited partner in a syndication, but you're able to take advantage of the cost seg benefits, and this property is levered up as it relates to that asset, right? Well, now you're in a scenario where you might find yourself in this position where if too many tenants can't pay, and you start seeing this asset class kind of shift where the Class A units that are coming on the market are starting to pull down and pull Class B kind of tenants up because they need to price it cheaper. And then now the tenants that were otherwise stabilizing your Class B asset can't quite make it, and it's harder to get debt payments, so maybe it makes sense to sell the asset, right? Okay, cool. Well, now the GP, the general partner, the one that's running the show, is going to be making the decision on whether or not to sell that asset and what that cash gain is going to be, independent of what the possible loss could be, because almost every syndication deal did a cost seg study. That was one of the biggest selling features, right? Is that fair to say, Joel?
Oh, yeah, absolutely. Yeah, and suddenly, as opposed to you controlling your own timing and your own destiny, somebody else does, and there's no guarantee or even likelihood that timing is going to work out best for you.
Yeah, so just there's a couple different variables to take away from this. One, knowing all the opportunity side of it, and then two, preparing if you're in these syndications, just take a deep look and make sure you're talking to the GP and are thinking a little bit further ahead in case that does come down the pipe. You might need to be looking for another asset to get into, or another way to offset that tax gain. But cool. Any parting words? Anything that we left off there you can think of, Joel?
No, I don't think so. I think we covered it pretty well. And again, I just appreciate the opportunity to sit with you for a while this afternoon, and hopefully we'll do it again sometime.
Absolutely. Well, I greatly appreciate you coming on. I think this was huge. I think people are going to get a lot out of this. My guess is quite a bit kind of went over most people's heads. This is about my fourth or fifth time kind of digging through it. So it's really starting to kind of layer in there. But I can tell you that even my first time or two, it was a lot. So if you need additional help, definitely reach out to your tax strategist. I'll put Joel's info in the show notes. Once again, Joel Dauve with Millhouse and Neal here in St. Louis. But beyond that, greatly appreciate it. Thank you, guys. We'll until next time.